It wasn't so much he was saying that the market's looking bad. He was saying you're way too restrictive, which you probably agree with.
Yeah, look, that's what I say. We're very restrictive, and you'd only want to be restrictive like that if you think the economy's overheated.
Today's episode is brought to you by Akash Network, the world's premier decentralized compute marketplace. Check out Akash to buy and sell computing resources securely and efficiently. Purpose-built for public utility at akash.network. Welcome in, everybody, to another episode of Coinage as we are watching one of the worst days for Bitcoin and Ethereum since. Actually, it is the worst day for Bitcoin in terms of percent sell-off as we look at the charts since the pandemic. For Ethereum, almost one of its worst days since the same time frame. Just one other day to watch to see if we top that one. But right now, Bitcoin off more than 10% in today's action. It's been a hell of a slide. Technical bear territory off more than 20% if you go back just on the weekly chart here for Bitcoin. As we watch everything play out, we're going to dig into where we're at, why it might be prudent to buy the dip here if you do believe that the worst is behind us. And one prescient call from JP Morgan to go back to on July 18th, basically saying 53,000 was fair value using gold. Guess where we're at? We are essentially right there right now at 53,000. Of course, all this tying back to the broader market action, the VIX, what we're seeing there. One of the crazier things to play out, I've been doing this a long time, and just when you put together all of these points, Texas, I think we have the chart for the VIX, biggest single day jump in more than 3 decades, highest level since the start of the pandemic. So again, not just crypto, we're watching kind of some of these comparison points to go back to the pandemic to see some of this volatility and huge market action. But just in general, the market suffering the same, and really Apple being off 11%. If you were to tell me that we'd have a sell-off like this and Bitcoin would be off pretty much percentage basis-wise close to what Apple is, I would say that's pretty crazy relative to what happened back in the pandemic when we saw crypto absolutely crater. We're also hearing some headlines from the Fed. Austin Goolsbee, who I've interviewed before on Yahoo, coming out and talking about what the latest thinking is at the Fed. Huge swings in terms of what expectations might be at the September policy meeting. Just want to go to those two to highlight just how crazy some of these swings have been in terms of expectations. Before, we were talking about the likelihood of a 25 bips cut in rates at that policy meeting. Now, when you look at the charts here, you're looking at about a 92% chance of seeing going all the way down to the 475 handle there in terms of potentially getting down that far. We already knew that the ease percentage probability was 100%, so everyone was expecting a cut. The question was, how big would that cut be? Going from 525 where we're at now, you're seeing a huge change in kind of where the market is on that front. We're going to dig into that a little bit later with what Austin Goolsbee said, the Chicago Fed president. But I do want to start kind of backing up and just thinking about how basically all of this fits in when we go back to the chart here, Texas, on the Bitcoin chart and kind of how it fits into the broader index. We can keep this chart up if you want. Japan, of course, this is kind of where all this comes from. We had talked so much about, the Widowmaker trade, the carry trade, the idea of people borrowing cheap and going out and buying assets. And Japan had, for the longest time, basically said, we're going to keep interest rates extremely low. And all of a sudden coming off that, this is the trigger of the volatility here, coming off of it, raising rates, the idea of the dollar and the yen, that relationship. Japan's Nikkei suffering its worst single point drop ever today. Worst percentage drop since 1987. You got to go all the way back to the old Black Monday. We might have a new one here. But wiping off entire year-to-date gains for that index in Japan. And, it brings up questions for what the Fed now wants to do in terms of the dollar yen. That's basically what everyone's watching. And perhaps it's no surprise to think about, what the big players in crypto had been doing for a long time too. MicroStrategy is another stock to watch today, I think, in this session. Last I checked, it was off quite a bit in the session. right now. Let's bring it up if we can. Not Microsoft. We want to bring up a MicroStrategy. And you think about why this matters. Essentially, we had seen Michael Saylor, the idea of him potentially bringing up another $2 billion in funding to throw more money into Bitcoin. He hadn't said that they had actually bought. So this might be an opportunity for him to come out with $2 billion now in new financing to buy the dip. Because I'm pretty sure Michael Saylor's long-term thesis is unchanged. And I want to dig into that too, because there's a big difference between a safe haven asset, which clearly Bitcoin is not necessarily proving to be in the short term when volatility strikes. There is a big difference between a safe haven asset and a bet against currency debasement. And if you ask any Bitcoiner right now, they are saying long term, what we're about to see play out if the Fed does indeed issue a potential, what some people are calling for, a potential 75 basis point cut in rates, an emergency cut in rates, then that does play exactly into the theme of what Bitcoin's here for, which is a hedge against currency debasement. Very different than the idea of a safe haven asset when volatility strikes. It's more of a long-term bet versus a short-term bet. And perhaps we'll get into why buying the dip now might be the right time to jump in if you do have cash on the sidelines. Again, going back to that JP Morgan call from just about a month ago. But we do want to play the latest that we did hear from the Fed. Austin Goolsbee basically reacting in real time from what CNBC had aired earlier in the day from Jeremy Siegel, an American economist and Wharton professor, calling for an emergency Fed cut. I'm not sure that that would necessarily instill any confidence in the market necessarily, but if you're just tuning in and playing catch up to the macro trends, a lot of this is coming from, yes, the unwind of the carry trade out of Japan as they move rates higher and the dollar yen basically flips in terms of how much strength we've seen from the dollar through the year, but also has a lot to do with the unemployment rate unexpectedly shooting higher on Friday. The unemployment rate was expected, I think, around 4.1, had jumped to 4.3. So now there are a lot of questions about the underlying economy, not just the market. Of course, the market is one thing, but how strong the economy is in terms of potentially seeing a complete change in the unemployment rate start to shoot higher here. A lot of people are saying that potentially it's far weaker than the Fed expected. And that's some of the data they were basing some of their decisions on. We're wrong because of Hurricane Beryl and all the other kind of data anomalies that we've seen over the last month. So I do want to play kind of Austin Goolsbee, again, Chicago Fed president's reaction to Wharton's Jeremy Siegel calling for an emergency Fed rate cut. If you listen to him, and of course, he doesn't speak for the entire Fed, we're still going to wait to see what Jerome Powell and the rest of the Fed wants to do. But if you listen to what he said, he's still in the camp that the market does not equal the underlying economy, and so far didn't necessarily signal any idea that we would see an emergency Fed cut. Take a listen to what Austin Goolsbee said just a few moments ago on CNBC.
I'm a great admirer of his work. He does have a kind of a market-centric view that the Fed should react to that. And spiritually, something inside, I'm totally the opposite. My thing is the law doesn't say anything about the stock market. It's about the employment and it's about price stability. And let's maintain financial stability as that's going. If the market moves, give us an indication that over a long arc, we're looking at a deceleration of growth, then we should react to that. But I want to caution.
He was talking more about how restrictive he thinks we are
because of the market.
He was doing inflation calculations and where Fed funds are right now. It wasn't so much he was saying that the market's looking bad. He was saying you're way too restrictive, which you probably agree with.
Yeah, look, that's what I say. We're very restrictive, and you'd only want to be restrictive like that if you think the economy's overheated.
So restrictive is a big question here as we look at the chart in terms of the Fed stepping in this next move and where they want to go, because again, just a couple weeks ago, essentially everyone was pricing the idea of a 50 basis point cut that would be double where the Fed normally moves. Normally they just move in 0.25%. That's kind of what we normally see at these policy meetings. So there was an outside chance just 1 week ago, about a 10% chance that you would see this. Now, if you look at the chart, it's up to a 92% chance that you would see a 50 basis point cut at that September meeting. Essentially everyone in that camp now saying that the Fed is behind the curve and acted too late. So this is kind of, again, where we're at. And fits into the thesis of Bitcoiners that the market is addicted to the juice, ladies and gents, that the market needs the Fed to step in and provide accommodative policy. And we'll see what happens if this does indeed spin into not just a market story, but an underlying economy story heading into the election. Because if that's the case, then you don't just have the Fed providing accommodations, you have potentially another spending spree coming from the U.S. government, which again would potentially, play right into the hands of the Bitcoin story in terms of it being a hedge against currency debasement and government spending. And so that, in general, still means that the thesis is intact there. And I suppose we talked a little bit about MicroStrategy tanking, but it ties into the idea of why Bitcoiners like Michael Saylor still might be excited about what's to come in the longer term when you look at Bitcoin's price relative to the US dollar. So all of that just kind of pointing out a piece of kind of where we're at. And I want to highlight too kind of this idea against gold right now too, because when you think about Bitcoin versus gold, it's worth highlighting that gold is up in terms of gold futures. We can look at this chart essentially here, Texas. The idea of it being up 1% over the last month. If you look at other ways to measure gold, it's up even higher relative to Bitcoin. And I think that that's kind of crucial in some of the discussions that, again, are being played out right now in terms of what Bitcoin really is. Is it more of a flight to safety, as we had heard from Larry Fink? Is it more a safe haven asset, or is it more, again, just a hedge against currency debasement? And if that's the case, gold might actually be performing better than all of these things. And it's what we heard also from Jim Cramer just a few moments ago talking to David Faber about this idea of Bitcoin versus gold. Of course, Jim Cramer, per usual, bringing up that it's difficult to bring gold bullion out of Costco. And so I think that that's an important piece to consider. On the other side of this clip, we'll talk about the JP Morgan call, which is 100% spot on based on where we're at right now. But just take a listen to how David Faber and Jim Cramer were reacting to this idea of Bitcoin potentially not being what a lot of people thought it was, though I think everyone who's in the Bitcoin camp understands exactly what it is. Take a listen to what they said just a few moments ago.
Bitcoin was supposed to be
but it turned out to be not as good a store of value.
Store of value, thank you. Yeah, would we be safe in Bitcoin? Would have been the thought that perhaps
John
would.
Book.
That is not the case.
Well, it just turns out that gold.
It's connected.
I had a Nico Eagle on last week.
You had a who to what?
A Nico Eagle is a big gold company.
Oh, yes.
And what it comes out is that their stock has been a total winner, and they're very adamant that when things go bad, crypto will go bad with it, but gold won't, because we've only found about 1% more gold each year. There's just not a lot of gold to be found, and a lot of it's in high-cost places. So gold is maintaining its value. And I think that's great. And I think everyone should have 10% of their assets in gold if they can get it. And try getting that out of Costco. It's like really hard.
All right, so when we talk about right now this idea of a store of value, I think it's important to highlight kind of how people in the Bitcoin camp have always pushed back against what that actually means and kind of shifted more into a currency debasement hedge. And I think that that's definitely more fair to say, because we've seen Bitcoin trade as a higher beta, obviously, than gold. It doesn't necessarily play out when we see volatility like this strike. And again, the VIX seeing its biggest spike since the pandemic. Not basically, quite literally, that is what we're seeing. But when you think about what it means from here, I do want to highlight what we heard from JP Morgan and their research team on July 18th. Texas, if we have that chart in terms of the gold reversion to the mean, this is kind of what their thought process was in terms of where Bitcoin was trading. Keep in mind, you go back to July 18th, that was north of 64, I think, is when they pushed this note out. And so, again, it just kind of goes to show it wasn't an easy call to make, but essentially they were looking at the reversion to the mean here on this chart and Bitcoin's price relative to gold and relative to Bitcoin production costs when they look at miners. Looking at all that data, they pulled it out and said Bitcoin basically fair price would be 43,000 in terms of production cost. And when you compared it to a volatility adjusted comparison to gold, the price of Bitcoin would be more fair at 53,000. And again, that was back on July 18th. And basically said, look, a reversion to the mean is going to happen here. And that is exactly what played out, because if you get back to the chart, I mean, again, I just want to go back to this just to highlight when they issued the note. Let's look at this here, Texas. July 18th would have been around 64. Yeah, like I said. And then they say it's going to be 53 if you look at a reversion to the mean. And where are we today? 53. So I do want to give a shout out to the JP Morgan team for kind of being right. And I also want to back up and now talk about what you would be doing if you are, like me, where a good chunk of your net worth is in crypto. And you're sitting there and saying, well, you know, it would have been nice if I listened to this note a little bit sooner. So again, apologies for us. We did highlight that note a couple weeks ago. I would have pulled the clip of us showing you that we did talk about that note a couple weeks ago if I had time. But you can go back and look. We talked about it on Coinage. Did I give it the necessary credence that it may have deserved? Potentially not. And for that, I do apologize. That might be on me. However, look, we got punched in the mouth. Here we are sitting here at 53. You could say, well, shit, really wish maybe would have moved a little bit more into stables here. And yes, that is true. Perhaps a lot of people got caught sleeping on the unwind of the carry trade out of Japan. Macro thing that clearly even the market got caught flat on. However, here we sit at 53,000. You could say now is the time to buy the dip potentially versus where things could keep going. And this is where I think, you know, one interesting note to compare on. We had talked about FundStrat's research before. We had talked about kind of how difficult it is to look at, all right, what happens now? But when you think about risk reward, I will just highlight, even on the JP Morgan side, if you look at cost to miners, that's 43K, right? So we still have potentially $10,000 to drop on the price of Bitcoin if you look at that measure. They've already hit their $53,000 comparison to gold in reversion to the mean. But when you look ahead in this idea of how true it can be that over the longer term, you're probably going to see Michael Saylor continue his buy the dip with his $2 billion that he's trying to raise right now. And if he's doing it, is the thesis still intact? And I would say yes. I would say very clearly that I think you're in two camps on this. And I just want to pull up one more note from Fundstrat that they put out over the weekend, because I do think it is historically somewhat interesting to think about in terms of where do you want to be on this? And you got two choices to make. You could say, look, this is the beginning of a larger bear market where we're going to be doomed and everything's going to go down. And if you're in that camp, you should probably trade accordingly. But this is the chart in Texas. I don't know if you can see this. Yep, that's the one. Basically, Fundstrat's research is digging into, let's look at the Russell. So you can look at small caps in terms of what's expected when we see something like this, right? A 1 month return of 10%, followed by 5 days of basically carnage, minus 6%, and what happens after that. And this is their research. So shout out to Fundstrat for this. You could basically say, look, out of all these times, on average, and this is I think a sample size of 9, so not exactly a huge sample size, but out of all these times, on average, you saw the market jump back in terms of a median return over 12 months, 36%. 1 month, 6%, so jump back. But the one instance where it wasn't higher over the next 6 months was 2,000. So you're basically saying, look, if you don't believe that this is a 2,000-like collapse, you're going to be fine 6 months, 12 months out. Now, if it is a 2,000-like scenario, over the next year, you're going to see another 20% in losses here to be expected on average. And again, all of this is kind of your best guess. But I would say if you're not in the camp that, all right, all this is a bust and unwind of the AI boom and everything else that we've seen that has pumped markets, then you're going to be fine. And buy the dip would be the advice that people would normally say here. Again, not financial advice coming from yours truly directly, but I can only tell you what I would do here. And I would say, if you don't think it's 2,000, then you'd buy the dip based on everything that we're seeing. And I also think that in general, I don't think you see market collapses like the one we're seeing play out today. And again, we can go back to that VIX chart, Texas, just to put this in context, because it is the largest one-day spike we're seeing in the VIX since the pandemic. So when you have these things happen in markets, you got to ask yourself, are we seeing another 2,000-like collapse, or are we seeing a market anomaly unwind in front of our eyes? And I think it's more so the latter. And in general, the thesis of everything that's gotten probably myself and a bunch of other people in crypto because of this long-term story of Bitcoin being a hedge against currency debasement, that has not broken down. And when you think about that, I think it's reassuring on market days like this, as we are seeing again. I don't want to sugarcoat it. I don't want to sit here and say, hey, isn't it, not that crazy to see Bitcoin and Ethereum sell off like we are? No, it is. It is crazy. Ethereum basically wiped out a fifth of its market value when we look at this chart. This is an ugly chart. And I need to switch back over so you could see it, but it is an ugly one when it comes to a fifth of Ethereum's market value, a quarter being wiped off in just 7 days. That's not a nice chart to look at. And again, Coinage has its treasury in ETH. So is it one that I wish I saw coming and had moved to cash? Yeah, personally, and as someone who's steering our Coinage DAO on both fronts, it is painful. But again, all you can do is what you do from here. And so shout out to anyone in the community who saw this coming and was ahead of it. You should have told us. Would have enjoyed that. But at the same time, you think about the last time we saw Ethereum move this low. Where did it bottom out? Pretty much right now where we're at, 2,400. That was back in May of 2021. China had just banned crypto or financial payment companies from touching crypto back then in 2021. Ethereum collapsed, and that's basically the last time we've seen any move like this. So it's the worst one for Ethereum since May of 2021. Put all those things together, and I just want to give you the context of kind of where we're at. Of course, we'll be watching all of this per usual and all the big headlines at coinage.media, and that's what we're here for, to round up the best analysis headlines in Web3. But that's where we're at. And so the only caution I could give to everyone now is don't make any rash decisions, because as we've seen, the snapback can be just as violent as the move lower, especially if we are going to hear a Fed rate cut, anything to the likes of what Jeremy Siegel's calling for in a 75 basis point emergency cut. I don't think that's going to happen, but basically if you listen to what the market's saying right now, at least a 50 basis point cut come September, and we'll see what plays out over the days to come as the market digests everything we're seeing play out. But in general, that's kind of where we're at on this Black Monday of 2024. Monitoring everything for you per usual, and you can talk to us at coinage.media is where you can find us, access the Discord, throw more our way. But in general, a lot to digest. Just putting it in historical context here as we move forward. And again, potentially pointing out that the people who did see this crash coming at JP Morgan have essentially said 53K was fair price. We're there now. Do with that information what you will. That'll wrap up our Monday show per usual here on Coinage. I'm Zach Guzman for everybody here. Thanks again for tuning in. Catch all the latest headlines at coinage.media.